This is Joe Vaclavik from CME Group here in Chicago. Corn futures market has really collapsed this week. We saw some better than expected rainfall across a lot of the Corn Belt and some forecasts that are not necessarily as threatening as we had thought to start the week. You know, the December corn contract topped right around $4.17 earlier this week and traded down into the low 380s here on Thursday. So really a very, very poor action after what looked like a breakout on the charts in terms of the price. We're right back into the old trading range that had spanned, 3 or 4 months essentially. So right back into the old trading range here. USDA did release a crop production report this week. I'd call it kind of, I think, insignificant relative to weather. There were some changes to the demand side of the balance sheet. USDA upped their production estimate because of that higher acreage number. We already knew that that was coming, but they did not change the yield number, and they generally don't in July. They'll wait until they get a survey-based yield number in August, and that's when we'll see the USDA start to change the yield picture around. But again, yield production is really the big ticket item here this time of year. The trade is starting to lean toward a higher yield number after leaning toward a lower number just a few days ago. So the weather, really the biggest factor here. A lot of back and forth, but for the moment, the patterns look okay and not necessarily as threatening as they had been early in the week. Again, Joe Vaclavik from CME Group here in Chicago.